Okay, students, we have started the revision of investment appraisal. Let's discuss further concepts relating to NPV. We have discussed almost each and every concept. Like, for example, if we say NPV, so while calculating NPV, we consider only relevant cash flows. And we have discussed all the rules of the relevant cash flows. Plus, we did discuss how do we calculate tax saving from capital allowances. We have also discussed the concept of working capital, and we did discuss that working capital can never be consumed. Whatever actually we have invested in the working capital, at the end of the day, entire amount will be recovered. Now, few more things. For example, the concept of annuity cash flow. Actually, annuity cash flow means fixed annual amount for certain number of years. It could be 5 years, 10 years, 20 years, maybe 25 years, but it has to be a fixed annual amount. So fixed annuity means fixed stream of cash flows for certain number of years. Now, if your examiner gives you the annuity cash flows, the main point is for calculating the present value of annuity cash flows, you have to use annuity factor. So present value of annuity amount, it is equal to annuity amount into annuity factor. Repeat. Present value of annuity amount is equal to annuity amount into annuity factor. How do we calculate annuity factor? Even though it will be given to you, but still you should know how to calculate. Annuity factor is equal to 1 minus 1 plus I. I is the cost of capital minus n over the bracket divided by I. This formula of annuity factor starts from T1 onwards. Now, for example, if cost of capital is 10%, let's say we need annuity factor from 4 till 10. Assuming cost of capital is 10% and we need annuity factor from year 4 till 10. How do we calculate? It's very simple. First, we will calculate annuity factor from 1 till 10. Since we need annuity factor from year 4, so you have to deduct annuity factor from 1 till 3. You will get the final answer annuity factor from 4 till 10. So first we will calculate annuity factor for the first 10 years and then simply deduct annuity factor for the first 3 years. And then you will get the final answer, which is annuity factor from year 4 till 10. So let's see. Annuity factor for the first 10 years. 1 minus 1.1, the power is minus 10, divided by 0.1. Let's see what are we getting. Students, I'm getting 6.14 with a little bit rounding of 5. Otherwise, it is 6.14456. So 6.145. Now simply deduct annuity factor for the first 3 years. 1 minus 1.1 minus 3 divided by 0.1. Let's see. 1 minus 1.1, the power is minus 3. Students, I'm getting 2.486. 2.68. So with a little bit rounding of 2.48, you can make it 7. So 2.487. So 6.145 minus 2.487. I'm getting 3.658. This is if we need annuity factor, let's say from year 4 onwards. So how do we calculate? First, we will calculate annuity factor for the first 10 years and then simply deduct the annuity factor for the first 3 years. Then you will get the required annuity factor. So main concept is if you have been given annuity amount, then how do we calculate present value of annuity amount? Present value of annuity amount is equal to annuity amount into annuity factor. Okay, now we have one more amount, which is basically the perpetuity factor. Okay, students. What is the difference between annuity amount and the perpetuity amount? Perpetuity amount. What do you mean by perpetuity amount? Students, please reply. What do you mean by perpetuity amount? Can I say perpetuity amount means fixed stream of cash flow, which could be inflow or outflow annually, but forever. Fixed annual cash flow could be inflow or outflow forever. So if there is a fixed annual cash flow, it could be inflow or outflow, but forever, then that amount is called perpetuity amount. In case of perpetuity amount, how do we calculate the present value? Present value of perpetuity amount is equal to perpetuity amount into perpetuity factor. Okay. How do we calculate present value of perpetuity amount? Simply perpetuity amount into perpetuity factor. So what is the formula of calculating perpetuity factor? Simply perpetuity factor is equal to 1 upon WACC. Whatever the perpetuity factor comes, it will be from T1 till T infinity. Great. It will be from T1 till T infinity. Okay. For example, let's assume cost of capital is 12%. Assuming we need perpetuity factor from 5 till infinity. Let's say the cost of capital is 12%, but we need perpetuity factor from 5 till infinity. How we are going to calculate? First, we will calculate perpetuity factor from 1 till infinity. Whatever comes, then you will deduct annuity factor. Since we need perpetuity factor from year 4, so what comes before? We need perpetuity factor from year 5. So what we need to do? Simply deduct annuity factor from year 1 till the base year. Base year means previous year. Obviously, you need a perpetuity factor from year 5 onwards. So the base year is year 4. So simply annuity factor from 1 till 4 will be deducted. The final answer will be the perpetuity factor from year 5 till infinity. First, we will calculate perpetuity factor from 1 till infinity because the formula works from year 1 onwards. Then we will deduct annuity factor for the first 4 years. After deducting the annuity factor for the first 4 years, you will get the perpetuity factor from year 5 till infinity. Let's try. PF Simply perpetuity amount. Perpetuity amount means fixed annual cash flows forever. Fixed annual cash flows forever. That is perpetuity amount. In case of perpetuity amount, how do we calculate the present value? So present value of the perpetuity amount is equal to perpetuity amount into perpetuity factor. How will we calculate perpetuity factor? The formula is 1 upon WACC. But this 1 upon WACC, whatever the perpetuity factor comes, it is from T1 till T infinity. The question is cost of capital is 12% and examiner has asked us to calculate perpetuity factor from 5 till infinity. So how we are going to calculate perpetuity factor from 5 till infinity? First, we will calculate perpetuity factor from 1 till infinity. Then simply deduct annuity factor for the first 4 years. Why for the first 4 years? Because we need annuity factor from year 5 onwards. So we need to deduct annuity factor for the first 4 years. So perpetuity factor first you have to calculate from year 1 till infinity. That is 1 upon cost of capital. Let's see. Let's use a calculator. 1 upon 0.12. I'm getting 8.333. Let's calculate annuity factor for the first 4 years. 1 minus 1.12 power minus 4 divided by 0.12. Let's use the calculator. I'm getting 3.037. 3.037. So 8.33 minus 3.037. I'm getting 5.296. I'm getting the perpetuity factor 5.296. Okay, now let's say examiner is saying that we have annual income. Let's assume cash flow from T1 till T infinity. The amount is, let's say, 80,000. So simply annual cash flow from year 1 till infinity is 80,000. Tax is paid with a delay of 1 year. Tax rate is 30%. Cost of capital is 8% required. Present value of post tax cash flows. Please, student, try. Annual cash flow from T1 till T infinity is 80,000. Taxes paid with a delay of 1 year. Tax rate is 30%. Cost of capital is 8%. And you need to calculate present value of tax. Present value of post-tax cash flows. Please, every one of you attempt this and give me the answer. What is the answer, students, please? Present value of post-tax cash flow. Let's simply look at the question once again. Annual cash flow from T1 till T infinity is 80,000. Tax is paid with a delay of 1 year. Tax rate is 30%. Cost of capital is 8%. we are required to just calculate present value of tax cash flows, present value of post-tax cash flows. Very simple. T1 till T infinity. Your annual income, your annual cash flow is 80,000 from T1 till T infinity, but tax is paid with a delay of 1 year, so T2 till T infinity. If I take 30% of 80,000, it is 24,000. Now we need present value factor. Obviously, we need perpetuity factor from T1 till T infinity. Cost of capital is 8%. So the perpetuity factor from year 1 till infinity is going to be 0.08. 1 upon 0.08 gives me 12.5. So simply we multiply this with 12.5. We will get 1 million. Now we need an perpetuity factor from T2 till T infinity. We have already calculated PF from 1 till infinity. So simply PF 1 till infinity is 12.5. Now simply deduct discount factor of first year. Discount factor of year 1. Basically the discount factor and annuity factor of year 1 is same. So you will get PF from 2 till infinity. At 8%, at 8%, the discount factor for the first year is 0.926, 0.926. So simply 12.5 minus 0.926, I'm getting 11.574. Just take 11.574. So 24,000 multiply by 11.574. I'm getting 277776. So the final answer is 72224. So the present value of the post-tax cash flow is 7,22,224. 1 till infinity. This is 1 upon 0.1. Since we need perpetuity factor from year 6 onwards, you have to deduct annuity factor for the first 5 years. You need to deduct annuity factor for the first 5 years. At 10%, annuity factor for the first 5 years is 3.79. You will get a perpetuity factor from 6 till infinity. $6.21. So almost everyone got the same result. No issue at all. Yes or no, please reply. Students, you can reply this. Now, please, I just want to show you one more way to calculate the same result. But I would say, please stick to one method. There is no benefit of solving the same question in exam in two ways. How did we calculate this 6.21? Simply, first we have calculated the perpetuity factor from year 1 till infinity. After that, since we know that examiner has asked us to calculate perpetuity factor from year 6 till infinity, so what we did? We simply deducted the annuity factor for the first 5 years so that we can get the result from year 6 till infinity. And this is the result. Now, please try to understand another way of calculating the same thing. For the same question, perpetuity factor from 1 till infinity is 10. But obviously, we don't need perpetuity factor from year 1 till infinity. Actually, we need perpetuity factor from year 6 till infinity. We need perpetuity factor from year 6 till infinity. So obviously what comes before 6, that is 5. Just do one thing. Simply take the discount factor of base year. Base year means previous year. Obviously, if I need perpetuity factor from year 6 onwards, just take the discount factor of the previous year. So discount factor of year 5. At 10%, 1.1 minus power 5, you will get a discount factor 6.021. Simply multiply this with the discount factor of the previous year, base year. You will get the same result which we have already calculated. Student, what I did, first I calculated the perpetuity factor from 1 till infinity. After that, what I did, since I'm required to calculate perpetuity factor from year 6 onwards, just do one thing. Just multiply the perpetuity factor which you have calculated from 1 till infinity, multiply that with the discount factor of the base year. I hope all of you can see the result is exactly same. Now it is up to you. Either go for the first presentation or the second presentation. Now, is there any question regarding this perpetuity factor? Please, you can ask. Is there any question now, please? Okay, what is the question? Michael, what is the question? The question with the post-tax cash flow, which we have, is not clear. Why? Come here, please. Look at this. The time period of income is coming from T1 till T infinity. An exam question says tax is paid with a delay of 1 year. If tax is paid with a delay of 1 year, so can I say the tax will arise from T2 till T infinity? Student, please reply on this. If, for example, you people are earning in 2024 and the taxation authorities, they have informed you that taxation authorities, they will tax your income with a delay of 1 year. So the income of 2024 which you have earned, will you be paying tax in 2024 on that income or in 2025? Michael, when will you pay tax? If your country's tax authorities is 2000, this is the same thing. So same thing is happening here. If income is coming from T1 till T infinity, but the question says tax is paid with a delay of 1 year. So obviously we will be paying tax from T2 till T infinity. Is this clear now? Because of the delay, it is happening. So time period of income and time period of tax is different. It's not same. Okay. Now let me share one question so that we can solve one question. Wait. Okay, students, let's attempt this question. He back. See, my commitment, which I did announce in your relevant WhatsApp groups, that I'm going to give you the revision of entire FM through live revision classes. We are going to discuss each and everything, even though everything is already given to you in a pre-recorded form. But obviously, the objective of live revision classes, which I did mention, I think in my first class, that you will get the revision of each and every concept in the live classes. Okay. And this is just the class number 3. Obviously, number of classes are left, but please, it's a very humble request. You need to keep revising as well. Because if you're not revising, then it becomes difficult to recall the relevant rule when it is required. So you need to keep revising as well. And especially, please try to Never miss these live sessions, because live session, they give you the opportunity to recall number of things in a short period of time, and plus whatever question comes during the class, you can ask, obviously relating to the topic, not relating to any other things, that what is happening in the world. For that, there's a Google. Part A, calculate. And right now we have started our FM from investment appraisal. Okay. Calculate NPV of investment project in nominal terms. Student, what do you mean by nominal terms? Can I say nominal terms means with inflation? Nominal terms means with inflation. What are the two more terms for the nominal terms? Nominal terms. Can I say instead of nominal terms, examiner can use in the future, let's say monetary terms, another name is money terms. So nominal cash flow, money cash flow, or monetary cash flow all means the same. The meaning is with inflation. Calculate NPV of the investment project in nominal terms and comment on its financial acceptability. Can I say the financial acceptability is very simple? If NPV is positive, then project is financially acceptable. And obviously, if NPV is negative, we are going to reject the project. Part B says discuss how capital asset pricing model can assist. So can I say capital asset pricing? Simply cost of capital is our topic number 2. And when we'll be discussing cost of capital, then obviously we have to discuss the part B as well. Then how basically capital asset pricing model helps you in this sort of investment appraisal decision. Basically, just few things. You should know the objective of cost of capital. The objective of cost of capital is investment appraisal. If you're making investment in a new industry, in a different industry, then obviously capital asset pricing model helps you to calculate project specific cost of equity. How do we calculate project specific cost of equity? We will discuss this when we will reach on cost of capital. We will be discussing each and every concept, ungeared, geared, how to use the proxy company equity beta to calculate beta asset, and then gear up that beta asset with your own financial gearing to calculate project specific KE. So you just need to wait a little bit for that. Let's go for NPV. HEBAC company is preparing to launch a new product in a new market. Fine. It says a new product in a new market, which is outside its current business operations. If it is outside your current business operation, it means you are doing something new. You are diversifying, you are making investment in a new line of business. Logically, in case of diversification, we calculate risk-adjusted WACC. The company has undertaken market research and test marketing at a cost of 5 lakh. Student, what about this 500,000? Can I say this 500,000 is irrelevant? It is a sunk cost. Either we are making investment or not, this 500,000 will not be recovered, because you have carried out the market research before making the investment. So logically, this 500,000 is an irrelevant cost, as a result of which it expects the new product to be successful. HEBAC company plans to charge a lower selling price initially and then increase the selling price on the assumption that new product will establish itself in the new market. Makes logical what they are thinking. Forecast sales volume, selling prices, and variable costs are as follows. Sales volume is 200,000, 800, 900, and 400. Selling price 15, 18, 20, 22, 22. Variable cost. Selling price and variable costs are given here in current prices terms. Students, whenever examiner says current prices terms, can I say the inflation comes from T1, from the first year? If the data is given to you in the current prices, then inflation comes from the first year. selling price, variable cost, two things are given here in current price terms. Before taking account of forecast, selling price inflation is 4% and variable cost inflation is 5%. Okay, can I say since there is more than one inflation rate, so obviously it is now necessary to calculate NPV in nominal terms. Second, you can say it is mentioned in the question as well, but logically we have already discussed whenever you have been given more than one inflation rate, then it becomes necessary, compulsory to calculate NPV in nominal terms. And we know one more thing, if the cash flows are nominal, then obviously cost of capital will have to be nominal. And we have already discussed one more thing, let me repeat it again. Nothing is mentioned. If nothing is mentioned, then whatever cost of capital is given to us, we will always assume that cost of capital is nominal. But I did say, mention one thing, if nothing is mentioned in the question, then given cost of capital is always assumed as nominal. Okay. Incremental fixed cost is 500,000 per year. Obviously, incremental fixed cost is relevant. Again, current prices, so inflation comes from the first year. As a result of producing the new product, fixed cost inflation is 8% per year is expected. The initial investment cost of production equipment for the new product will be 2.5. So this is your initial investment. The initial investment cost of production equipment of the new product will be 2.5 million, payable at the start of the first year of operation. Production will cease at the end of 4 years. So the time period of the project is 4 years because the new product is expected to have become obsolete due to the new technology. The production equipment would have a scrap value 1,25,000 in the future value terms. In the future value terms, so it is logically in nominal terms. Investment in working capital is so 1,25,000 is a value of T4. Investment in working capital is 1.5 million. Will be required at the start of the first year of operation. We know that if you need working capital at the start of T1, you have to invest at time 0. Working capital inflation is 6% per year is expected, and working capital will be recovered in full at the end of the 4 years. So simply at time 0, we are going to make investment in working capital 1.5 million, but every year the requirement of working capital will rise due to the inflation of 6% per year, and at the end, entire working capital will be recovered. So it means that we have to work on incremental working capital. And always remember one thing, we always deal with working capital and scrap value after calculation of tax payment. Because if you show the working capital before the calculation of tax payment, then your tax payment is going to be incorrect. So you always deal with the working capital in the main format after you have calculated the tax payment. ABAC company pays corporation tax 20% per year, with the tax liability being settled in the year in which it arises, same year. Okay. The company can claim tax allowable depreciation on a 25% reducing balance basis on initial investment cost. And initial investment cost is 2.5 million. So we need to calculate tax saving from capital allowances as well, adjusted in the final year of operation for a balancing allowance or charge. Logically, just for the sake of little concept, otherwise we know that in the last year, you just need to calculate the balancing figure. Logically, if there's a loss on disposal, then in taxation terminology, we say balancing allowance. And if there's a gain on disposal in taxation terms, we say balancing charge. So balancing allowance means loss on disposal in taxation terms, and balancing charge means profit on disposal. ABAC company currently has a nominal after-tax weighted average cost of capital 12%. Real is 8.5, so real is not needed right now, because the requirement itself says you need to calculate NPV in nominal terms. The company uses its current WACC as the discount rate for all the investment projects. Logically, whenever you are making investment in a different business, in a different industry, So you should not be using your current WACC. You should be using a risk-adjusted cost of capital. Logically, what happens whenever we are going to make investment in a different industry, then business risk will change. So when the business risk changes, then logically, your existing cost of capital will not be so relevant. The main thing is then you should be calculating a risk-adjusted WACC, which is more relevant. But obviously, that is the pure discussion for the part B. In part A, there's no need to do anything. Obviously, in part A, we'll be calculating NPV by using 12% cost of capital because it is question says the requirement, they say calculate NPV in nominal terms. So first, let's incorporate the inflation to the selling price and variable cost. Selling price inflation is 4% and variable cost inflation is 5%. Let me just quickly show you the working one. Let's calculate sales. Time T1, T2, T3 and T4. Okay. Let's ignore everything is in dollars. Let's try to ignore 3 zeros. If I ignore 3 zeros, demand 200, 800, 900 and 400. 2, then it was 8, 9 and 4. Selling price per unit. Selling price. Student, they have given us the selling price 15, 18, 22, 22. 15, 18, 22, 22. 15, 18, 22, 22. Inflation per annum. Let's see the percentage of inflation for the selling price. Selling price inflation is 4% per year. So simply 1.4, then here 1.4, 1.04, 1.04 square because of the second year is going to be power 3 and then let me use the calculator. I want you, every one of you also use the calculator so that there should not be any arithmetical error. I'm getting 3,120. 800 into 18 into 1.04 square. I'm getting 15,575. Let's recheck. For the third year, 900 into 22 into 1.04 and the power 3. I'm getting that is 22. It's 22. So 900 multiplied by 22 into 1.04 and the power is 3. 22272. Student, please check. Okay, 400 into 22 into 1.04 and the power 4. 10, 29 and with a little bit rounding of 5. 10,295. Okay, let's go for working 2. variable cost. T1, T2, T3, and T4. Let's ignore 3 zeros. Demand. Let me change the color. Demand is 200, 800, and 9 and 4. 2, 8, 9, and variable cost per unit. Let's see. Variable cost per unit. Wow, it is 9. Variable cost per unit is just 9. And what is the inflation? Inflation for the variable cost is 5%. So variable cost per unit is 9. Inflation is 5% per annum. Inflation is 5% per annum. So 200 into 9 into 1.05. Okay. 200 into 9 into 1.05. I'm getting 1890. 800 multiplied by 9 into 1.05 and then power 2. I'm getting 7,938. Please, student, do check. 900 into 9 into 1.05 power 3. I'm getting 9,376.7. So make it 77. 9,377. 400 into 9 into 1.05 power 4. 4,375.8. So make it 6. Okay. Now what? Fixed cost inflation is 8%. So this 8% we will deal directly. Directly we can increase fixed costs by 8%, no issue at all. Now let's try to deal with working capital. That is more important. Because due to inflation, the working capital requirement will keep changing. So working 3. Working capital. Basically, time period of the project is 4 years. Now, please try to understand T0, T1, T2, T3, and T4. Again, we are ignoring obviously 3 zeros. Initially at time 0, working capital is 1.5 million means 1500. Working capital is 1500. But after that question says this working capital will increase by what? Inflation? By 6%. So inflation is 6% per annum. Which means that if we increase this 1500 due to this inflation, so we'll take 1500 logically into 1.06. 1500 into 1.06. Just use the calculator. 1500 into 1.06. I'm getting 1590. So logically in T1, the total requirement of working capital will be 1590. Now, please look at this. So inflation rate is 6%. So logically, this will become 1590. Then simply increase this 1590 by 6%. So 1.06. I'm getting 1685. Then 1685 multiplied by 1.06. I'm getting 1786.5. So make it 1787. Since working capital can never be consumed, so whatever we have invested at the end of the day, it will be recovered. But we do not work on cumulative working capital. We always work on incremental working capital. Let me show you. So initially the working capital requirement is 1500. There's no doubt about it. After that, the working capital requirement is increased from 1500. It goes till 1590. So 90. Then from 1590 till 1685. See the difference? 1685 minus 1590. I'm getting 95. 1787 minus 1685. 102. So incremental working capital requirement is 1500, then 90, 95, 102. And T4 is the last year of the project. At the end of the project, whatever we have invested in the working capital, it will be recovered. So the total investment in working capital is 1787. Total of the working capital, mathematically, it has to be 0. Total has to be 0, and it is happening here. So incremental working capital is 1500, 90, 95, 102, and then the recovery is 1787. Okay, now one more working. Whatever the tax, AHMED company pays corporation tax 20% per year, with the tax liability being settled in the year in which it arises. In the same year, we are paying the tax. Initial investment. Let's find out the initial investment. Initial investment is 2.5 million. By ignoring 3 zeros, it becomes 2500. So initial investment is logically 2500 because we have ignored 3 zeros. And tax depreciation is available by using 25% reducing balance method. So let's try. Let's calculate tax saving from capital allowances working for. Tax saving from capital allowances. Tax saving from capital allowances. T1, T2, T3, T4. Simply capital allowance, another term which you can use is tax depreciation. Tax saving. So we have ignored 3 zeros. So 2500 into 25%. Let me use the calculator. 2500 into 25%. I'm getting 625. In reducing balance method, what do we do? You will take 2500 minus 625. So 2500 minus 625, the net book 2500 minus 625. The net book value is 1875. If I take 25% of 1875, I'm getting 468.75. Instead of this, the shortcut is just take 625. Take 75% of that. Obviously, 468.75 means 469. Then 469 into 75%. So 469 into 75%. I'm getting 352 with a little bit rounding off. In the last year, students, we always take the balancing figure. In the last year, we have to always take the balancing figure. How do we calculate balancing figure? Cost, which is 2,500 minus the scrap value. Let's go for the scrap value. Examiner has given us the scrap value. Scrap value is 125. Scrap value is 125. So what are we doing? I have given the reference of IAS 16 property plan and equipment. According to property plan and equipment, only depreciable cost should be depreciated over the useful life of the asset. Depreciable cost means cost minus scrap value. Depreciable cost means cost minus scrap value. So 2,500 minus 125. The depreciable cost is 2,375. And logically, the balancing figure will automatically be having the impact of gain or loss on disposal. From this 2,375, deduct all these three. So 2,375 minus 625 minus 469. 2,375 minus 625 minus 469 minus 352. I'm getting the balancing figure 929. The balancing figure is 929. Tax rate. What is the tax rate? Tax rate is 20%. Tax rate is 20%. Let me change the color. Tax rate is 20%. So 625 into this, the tax saving is 125. 469 into 20%. 93.8, make it 94. 352 into 0.2. 70.4, make it 70. 929 into 20. 185.8, so make it 186. Okay. Now let's try to calculate NPV. So don't worry at all. Other questions in our live revision classes we'll be discussing. I have solved number of questions on Excel for you in your regular course, but obviously in the coming classes we'll be solving the question on Excel as well and on the CB format, in the CB format, so that you should exactly know what sort of format you are going to face in exam. Okay, NPV. Let's calculate that. Time T0, T1, T2, T3, and T4, because the project life is 4 years. We have ignored 3 zeros. Initial investment is 2,500. Initial investment is 2,500. Sales, that is working one. So we have to look at the sales. The amount of the sale is 3,120, 15575. So it is 3,120, 155, then it was 75. Triple two 72, 10,295. Triple two 72. Triple two 72 and 10,295. Variable cost is working to variable cost is working to. Let's go for variable cost. It's here 1890 7938 7938 1890. Then we have 9377 4376 9377. Fixed cost. Let's see the inflation rate of the fixed cost. I think it was 8% if I'm not wrong. Fixed cost, fixed cost, fixed cost. Fixed cost is 500 current price. So inflation comes from the first year and inflation rate is 8%. Fixed cost, logically, it is increased by 8% from T1 till T4. Just use the calculator. 500 multiplied by 1.08. I'm getting 540. Then this 540 multiplied by 1.08. I'm getting 583. 583 multiplied by 1.08. Oh, 583 multiplied by 1.08. I'm getting 629.64. So make it 630 into 1.08. I'm getting 680.0112. So make it 680. Okay, very easily we can calculate taxable profit now. P120 minus 1890 minus 540. I'm getting 690. 15575 minus 7938 minus 583. 7054. 2272 minus 9377 minus 630. 12,265. 10,295 minus 4,376 minus 680. I'm getting 5,239. This is the taxable profit. Tax is 20% paid in the same year. 690, then 0.2, 138. 7,054, then 20%. 1,410.8. So make it 1,411. 12,265 into 20%. 2,453. 5,239. 1,047.8. So make it 1,048. Now simply take tax saving from capital allowances. Tax saving from capital allowances or tax saving from tax depreciation. So same thing. Give the working reference. It was working 4. Either you are writing tax saving from capital allowances or tax saving from tax depreciation. Please, it's the same thing. Do not get confused in this. 124. Oh, sorry, your first one is 125, then it is 94, 70, and 186. Now let's deal with working capital. Working capital and recovery. What is the working capital working? It is working 3. It is working 3. So initially we need 1500 at time 0. Then I believe it was 90. But after that we have to see. 95,102. 95,102. And at the end, everything was recovered. It was 1787. It is 1787. Let's take the scrap value. 125. So we have considered we have taken every cash flow. Let's calculate net cash flow. At time 0, obviously it is 4,000. But we have to calculate here, T1. Obviously, when you solve this thing on Excel, it becomes very easy by using the sum formula. 690 minus 138 plus 125 minus 90. I'm getting 587 in the first year. And obviously we have when we'll be solving the same question on Excel, so you will be using the shortcut of NPV. All those shortcuts which are available in financial management paper, you are supposed to use them. And one of the shortcuts is NPV. So NPV shortcut is available 7054 minus 1411 plus 94 minus 95. I'm getting 5,642. So 12,265 minus 2453 53 plus 70 minus 102. I'm getting 9780. 5239 minus 1048 plus 186 plus 1787 plus 125. 6290. 6289. Okay. 628889. Let's go for the nominal discount rate. It is 12%. So cost of capital is 12%, 1.893977126636. Present value of net cash flows, obviously 4,000. 557 multiplied by 0.893, 524. Okay. 5,642 into 0.797. I'm getting 4497. Okay. What is the third one? Third one is students are saying 6962. Okay. So, and the last one, 3996. Let's see. 3996. 9780 into 0.712. That's just perfect. 979780 into 0.712. I'm getting 969. Just make it 3. 6289 into 0.636. That is different, I'm getting. I'm getting 4,000. Let's see what is the NPV. Obviously, it is positive. Positive. $11,984. So simply NPV is positive. Can I say the project is financially acceptable? NPV is positive. Therefore, project is financially acceptable. NPV is positive, so that is why project is financially acceptable. So students, you might have noticed one thing in today's class. We have discussed obviously the concepts of investment appraisal, as well as we have discussed the entire question on NPV. As I already mentioned, 12% is given to you in the question. What is the problem, Mohammed? What is the problem with the 12%? When your cash flows are nominal, then cost of capital will be nominal. So where is the problem? Can you explain that? When cash flows are nominal, cost of capital will be nominal. We have discussed this point. So nominal cost of capital is 12%. It is written in the question. Can you please explain what is the problem in this? Where is the problem in 12%? I'm waiting. We have discussed this concept. When cash flows are nominal, then cost of capital will be nominal. You can see this. See, these are the basics. I think you have missed the previous classes also, it means. What it says, weighted nominal after tax is 12%. No. Why you have not seen the question? You should have seen the question. So when cash flows are nominal, then cost of capital will be nominal. So students, you have noticed in today's class, we have discussed the entire question as well. We have discussed each and everything. We have discussed each and everything. So I am on my commitment to give you the revision of entire financial management through live revision classes. But please attend all the live classes. Do not skip. And just one message, those students, they are watching this lecture on my YouTube channel. Quickly, I'm just giving ASA admin number. Those students, they are outside Pakistan. Then our admin number for them is 0092 333 666 214. You can contact the admin. Those they are within Pakistan, the admin number is 0333 666 214. So please, students, try to watch the lectures as soon as possible. And after watching the lecture, try to revise again and again. The more you will be revising it, automatically you will become in a position to recall the concepts. So thank you very much for coming up for the today's class and attending. Do give the feedback of for the today's class in your relevant WhatsApp groups. Thank you very much. And this lecture will be uploaded on your portal as well. Thank you.